If you're trying to create consistent weekly income from the market without blowing up your account, without getting margin calls, and without taking insane risk, this video is for you. Today, I'm gonna walk through a ticker, XLE. It's an energy sector exchange traded fund, highly liquid, and I'm gonna show you exactly how to evaluate it for selling puts, selling covered calls, and structured income trades. If your goal is creating income without losing all your money, this is going to be important. Now, before I go further, big shout out to the man TC in one of my private groups because he brought this ticker up. I wasn't really familiar with it, but once he asked about it and I looked at it, it's a great example to create income in a low risk way. It's not about making money, guys. It's about making money and not losing money. And that's why you want to focus on tickers like this one. So first, let's talk about what XLE is. It's a SPDR ETF, an exchange traded fund. So it's got a whole bunch of different stocks in it. Super, super safe. Its top holdings include companies like ExxonMobil, Chevron, ConocoPhillips. So instead of trading just one oil stock, you're trading the whole sector. It gives you a little bit more safety and cushion. And when we look at this ticker in particular, it's got really low volatility, but the premium is still really good. I'm gonna walk through all the details using my screen in this video. Now stay until the end because I'm gonna show you exactly how I would trade this personally. Now before we jump right into the video, do me a favor, subscribe to the channel. I'm putting up a video every single day, breaking down trades and showing you exact examples just like this one, and you don't wanna miss out. Now let's jump right in to my screen. Now first, we're gonna pull up a 1-year chart. I'm showing you my screen on Thinkorswim. Now when I evaluate an ETF for income strategies, or basically when I evaluate any ticker for an income strategy, I look at the following things. I look at liquidity, I look at options volume, bid-ask spreads, volatility profile, sector stability, and if I'm using margin, I look at how much margin I can get from that trade. XLE checks all the boxes for me. Let's break it down. I'm gonna start by pulling up a February 20th option chain. This video is being recorded on the 11th, but it will post on the 12th. So the live numbers when you watch this video might be slightly different, but what I'm doing is showing you screen by screen, click by click, exactly how you evaluate the process. Now XLE right now closed at 54.98 on Wednesday. If I don't have a position in this ticker already, I'm always gonna start with selling a put. Selling a put is committing to buy the stock, but only if it drops below a certain price before the contract expires. If it doesn't drop below that price, you don't buy the shares, but either way, you get to keep the premium. Now we can see by looking at the chart that there's not a whole lot of volatility with XLE. It's pretty slow and steady, although it's been on an uptrend for the last couple of months. And when we look at the implied volatility here, it's got a pretty low range, about 25%. That's showing you how much swing the ticker is expected to have over the next year. Now, the first thing that we're going to look at is the options liquidity. And I'm going to start by looking at a February 20th, $54 put. We'll see the delta on this contract is 29. What that means is there is an approximate 29% likelihood that the stock is going to drop below $54 before the contract expires on February 20th. When we sell our first put, we want to stay a little bit far away from where the stock is currently trading. So for example, we wouldn't probably want to sell a 54.50 put because that's too close to where it's trading right now. We also want to take a look at the volume and make sure a lot of people are trading this particular ticker. And we can do that a couple of ways. First of all, we can look at the bid-ask spread. And when it's tight like this, 40-cent bid and 41-cent ask, that means it's very, very liquid. And we can also see the volume of this particular contract is almost 3,000. That's a healthy number. Now, as I'm evaluating selling a put, I'm always going to calculate the rate of return because I want to make sure, am I making enough return for the risk that I'm taking? And we do that in a very easy way by pulling up a calculator. We're going to divide the premium that we take in on this contract, which would be $40. You can see 40 cents right here. And the reason it's $40 is because each contract represents 100 shares, meaning that $40 would get dropped into our account right when we make the trade. We're going to divide that by the capital we need to put the trade in. In this case, it's a $54 strike price. That means we need $5,400 in our account if we're not using margin, because we're committing to buy 100 shares at $54. That gives us a rate of return of about 0.7%. But we're only holding this contract between February 12th and February 20th. That's a total of 6 days, Thursday and Friday. And next week, Monday, the market is closed for the holiday. So we're going to divide this by 6 to get our daily rate. And then we're going to multiply by 252 to get our annualized rate of return. That gives us about a 31% annualized rate of return. Pretty good. Now, before you put this trade in, you want to ask yourself, am I okay buying 100 shares of this particular ticker, XLE, at $54 if the price drops? You want to be prepared to do that. Now, many traders are afraid of being assigned in case the price goes lower, but you don't want to be afraid of that, because if you were to get assigned those shares, you turn right around and sell a covered call against those shares. And XLE has a little bit of uniqueness to it in the sense that it also pays a dividend. Now, the easiest way that we can see the dividend information is just to Google it. I typed XLE dividend dates in Google earlier today, and it tells me that the next dividend is paid in March, and it last paid about 37 cents per share. So if you do have to buy the shares, you'll be making income on the dividend while you hold them. Now, I also want to show you how margin might work, because it's possible you might not have $5,400 to make this particular trade. Now, the easiest way to see what the margin requirement would be on your trade is to click the bid of the contract that you're looking at. And it pulls up an order entry box that we see below. You're going to right click this and click Analyze Trade. And the bottom right hand corner is going to show you the margin required to make this trade, about $1,000. So you see, you don't necessarily need all the money up front in order to take in income from selling a put. Now, I want to say this. You have to be very careful when you're using margin, because if the price of the stock starts to go down, the value of your account is going to drop as well. And you could be undercapitalized, causing a margin call. So you don't want that to happen. Now, this video is pretty short, so I'm not going to go into all the details on margin, but I do have other videos that talk more about that. Another point I want to make in this video is about contract size. I've seen too many traders blow up their accounts because they're trading position sizes that are too big for the value of their account. I suggest you only start with one contract, and you want to make sure that you have cash on the side in case the ticker drops. You want to be able to buy more shares as it goes lower. So what do you guys think? Can you see how easy this can be to create income in a safe and steady way on a regular basis? Now, when TC mentioned this particular ticker in our session this week, it sparked an idea for me. Community is so important. When you get together with like-minded people, you get to share different ideas. I wasn't familiar with XLE, and when he mentioned it and I walked through it, it's a great ticker. It's got pretty low volatility, 25%, but you can still make like 30% on an annualized basis. Worst case scenario, the price of the ticker drops, you buy the shares, you collect a dividend while you own them, and then you sell covered calls against them. This is a great way to get your feet wet, especially if you're new. Now, TC is part of my February trading group, and that session is closed, so I'm not taking any new people. But I want to provide the opportunity in a separate program on a regular basis. So starting on Monday, I'm going to run a live session every single week from 12 p.m. Pacific time until 1 o'clock Pacific time for 1 hour. And it's going to be live while the market's open, and we're going to walk through exact trades just like this. You can either share your screen and I'll walk through it with you step by step, or you can just tell me the ticker and what we're looking at, and I'll use my screen to do it. So you can learn directly from me, and you can get great ideas from your peers. Now, I'm going to drop the details in the comment section below, but it's going to be an insane price. $99, month-to-month subscription, cancel anytime. Every single week for 1 hour live. And if you miss the session, you'll have access to the recording. Now, if this video helped, smash the like button. Be sure to subscribe to the channel. I'm putting up new videos every single day, walking through different tickers with the primary focus on creating income on a regular basis. And tell me in the comments, what do you think about this particular ticker, XLE? Is TC the man or what? Thanks for watching and happy trading.